Thank you, Mr. Chairman, members of the committee. It is a privilege to be with you again today. I've appreciated the opportunity to testify before this committee previously and to meet with a number of you. So again, thank you for having me. This is one of the more challenging issues that I think a committee like this has to address. Personal property taxes are one of those taxes that most states, on a bipartisan basis, if you talk to legislators in most states that have them, they say they don't want to have them. This is not the tax structure they would have created if they were starting from scratch today. But they're there, and it's very difficult to know what to do with them, in part because they are a local tax with highly disparate distributions. So I do want to talk a little about why West Virginia has them, why states are trying to move away from them, and some options for doing so. Now, West Virginia statehood, of course, dates back to 1863, and so does the property tax. It was one of the first taxes levied. It existed from the start. So as I come before you this morning to discuss property tax reform, I am cognizant that I'm discussing a tax with a long history that hasn't changed a whole lot during that period and is very difficult to change. Its structure is relatively similar from its first imposition to the present day. I'm also aware of how significant a revenue stream it is for localities and how much the personal property tax plays into those total collections. And so there are many hurdles, of course, to surmount in reforming local taxes and especially property taxes. Localities do have a high degree of reliance on them, some very high. The distributional variation in reliance on personal property taxes as a source of local revenues does lie at the heart of the challenges of any reform or any attempt to overhaul or roll back those taxes on tangible personal property. That's why eliminating personal property taxes has been a mainstay of tax reform commissions in this state and elsewhere. Both the 1999 Underwood Commission and the 2006 Manchin Commission recommended the elimination of personal property taxes along with the elimination of the franchise tax. Of course, one was accomplished. Personal property taxes remain. Because those challenges are so significant, but I don't believe they're intractable. So today I'd like to talk about why states are increasingly moving away from taxing personal property and outline a few possible ways forward for West Virginia. Now, of course, as you all know, property taxes are ad valorem taxes, meaning it's imposed according to the value of the property. We heard a presentation earlier about the different way that assessments are done, and it's extremely complex. And every state has a different approach to assessments, which is, of course, also challenging for businesses that are that have property in multiple states because there are often extremely different approaches. You might ask, for instance, why do we have a 60% assessment ratio? You could just have a lower rate rather than applying a 60% assessment ratio. It's one more step that doesn't really do a whole lot. And states do this sometimes. Many states apply it to 100%, some do 60. Some states do 35 or 31. They pick random numbers sometimes almost. And of course, if you think it through, you realize that adjusting the rate, a higher rate against a 100% assessment ratio would be the exact same thing. Why is this done? It's sometimes unclear, why some of these steps have been taken because they accomplish the same purpose with a little more paperwork. For I think the average West Virginian, the property tax is roughly synonymous with the tax on real property. But of course, members of this committee know that that is not the case, that a third of property tax collections are remitted on the value of business tangible personal property, that the majority, it's a small majority, but nonetheless the majority of all property taxes are assessed on other than residential property. That's being assessed on business property, on you have utility property taxes as well. I do have collections up there for real, personal, and utility. Recognize that real property, of course, is 54% is real property, but that includes a lot of business property because businesses, of course, own real property as well. The majority of property taxes in West Virginia are paid by businesses. Businesses are a significant payer in all states. However, it is weighted much more strongly towards businesses in West Virginia than it is in most for a number of reasons. One, just in many ways the nature of the industry that's in West Virginia. Two, the differential tax rates. There are not uniform tax rates on different classes of property, as you're well aware. And just three, the way the personal property tax is treated. So in 1999, the Commission on Fair Taxation proposed eliminating tangible personal property taxes and the business franchise tax, identifying both as barriers to the state's economic growth. In 2006, the Tax Modernization Project made an identical recommendation. The franchise tax has been phased out, for which I think all of you deserve a great deal of credit. That's a great progress for a state. But personal property taxes remain, and it really is little wonder given the distribution of reliance on the tax. You know, of course, that there are several different taxing authorities, that there are different entities that rely on this tax. You have counties, which rely extremely heavily on property taxes. You have municipalities. You have schools that are, of course, relying on this tax revenue. So looking at counties, just by way of example, about 10.9% of Morgan County's property tax collections are derived from personal property taxes. On the other end of the spectrum, in Douglas County, it's 78.5% of all property taxes are personal property tax. Similarly, wide variations are evident at the municipal level. Obviously, reliance on property taxes as a percentage of all collections is lower on the municipal level, but the variation of the percentage that is associated with personal property is very similar in its distribution. Statewide, about 32.8% of all property tax collections are attributable to personal property tax. So, clearly a proposal that holds Morgan County harmless is not going to cut it for Doddridge County. A solution that preserves Doddridge County's revenue streams is going to result in anomalously high tax burdens in Morgan County. In 9 counties, personal property taxes alone account for less than 20% of all property tax collections. In 7 counties, it's more than 50%. Again, that is a very difficult, although I don't believe intractable problem. Of course, property taxes are the single most important local revenue source, competing with the business and occupation tax for the top spot in each tax jurisdiction. Statewide, 58% of all local revenues derive from property taxes, and 19% of all local revenue is due to personal property taxes. As a share of state and local revenue, personal property taxes are more than double the national average. About 4.78% of all state and local tax collections are attributable to personal property taxes. The national average is a little under 2.25%. In Doddridge County, I'll just use that as an example again, property tax collections are 64% of all county collections. And that means that personal property taxes alone account for more than half of the county revenue. In the municipality of Morgantown, by contrast, personal property taxes are a mere 3% of revenue. Tackling personal property tax reform in a way that works for both Hardy and McDowell, Pendleton and Marshall, Morgantown and South Charleston, that really is the challenge this committee faces, on which I hope to offer a few suggestions. All but 8 states, those are Delaware, Hawaii, Illinois, Iowa, New York, Ohio, Pennsylvania, and South Dakota, include tangible personal property in their property tax base, though a few others, like Minnesota, New Jersey, and North Dakota, tax very little personal property. The other 42 states, including those last 3, with personal property taxes of some sort, of those, all but Oklahoma have an exemption for household goods or for non-income producing property. So, homeowners aren't paying on their sofa and, most of their, personal possessions, most states, and this is somewhat new in some states. A number of states until the last decade or so did have these taxes, and very few states really want someone to have to figure out the value of their silverware and pay taxes on it. So states have moved away from that, with the exception of Oklahoma. In addition, to the 8 states which exempt personal property taxation and the 3 which barely tax it, a few others very narrowly define the personal property tax base. Minnesota and New Mexico are examples of that, and they have essentially been trying to wean their states off personal property taxes by narrowing the base a little more each few years. There, of course, is still some property subject to tax there. States are increasingly taking steps to limit these taxes. West Virginia is now one of only 10 states, for instance, which taxes inventory on a broad scale. You have a handful of states that allow it to be taxed at the local level as an option. You have some states where a very small amount of specific types of inventory are taxed. But as a general tax on inventory, West Virginia is one of only 10 states. And that's an issue, because inventory taxes are some of the more distortive taxes you can have. It does change which industries want to be located in West Virginia, and it dramatically increases costs for a number of businesses that do choose to be here. So given the scope of the challenge, it's worth taking a step back and asking why states are slowly moving away from personal property taxes, why 2 tax commissions in this state have recommended for eliminating personal property taxes, and why personal property taxes are up for discussion again this year. Why reform is worth doing, challenges notwithstanding. Firstly, property taxes are a highly significant business tax cost. It's easy to conflate business tax liability with the corporate income tax. I think that's what a lot of people do. But according to the Council on State Taxation, 27.8% of state and local business taxes remitted in West Virginia are property taxes. And a very generous share of that total is due to personal property taxes. If you're worried about the tax costs of doing business in West Virginia, personal property taxes matter. Secondly, personal property taxes are a tax on capital formation. It's a truism that what you tax, you get less of. And in this case, a disproportionate share of the tax burden is falling on capital, making it significantly more expensive to grow a business with all of the attendant effects, including, of course, on job creation. Thirdly, taxes on tangible personal property are distortionary because they apply to some business inputs but not to others. All else being equal, taxes on machinery and mechanical property disincents the use and accumulation of additional capital because it becomes more expensive relative to labor and also relative to other property that may be taxed at a lesser level. It also creates an incentive for mobile capital to flow out of high tax areas and into low tax areas. Of course, comparing this to real property, real property is of course situated where it's situated, and if there is value to being there, and there may or may not be, businesses will move based on real property taxes as well, but if there is a value to being located in a certain place, if there's value to that land, that's where you have to locate. A lot of tangible personal property is relatively mobile. It can flow out to other areas, even if a business remains headquartered in a particular location. Fourthly, personal property taxation is what we call taxpayer active, meaning that businesses must fill out tax forms listing all of their tangible personal property, which adds substantially to compliance costs. This, of course, contrasts with real property, which is taxpayer passive. A statement is issued valuing the land improvements, and then property tax is owed, and then the property tax owed, and it's sent to the property owners. It alleviates the compliance costs. Of course, there's a cost for government to administer this, and that's significant as well. But for the taxpayer, you pay what the assessment says you owe. For personal property tax, that is not the case. There is an active component to determining your liability. Fifthly, personal property taxes do not pass the benefits test and are indifferent to profitability. A shortcoming also associated with West Virginia's business and occupation tax, of course, a gross receipts tax at the local level. Corporate income taxes are obviously assessed on net income. Personal property taxes are based on the value of businesses' equipment, inventory, and fixtures. This severely undermines tax neutrality. A capital-intensive, low-margin business pays a far greater share of its net income in personal property taxes than does, by contrast, a labor-intensive, high-margin business. And the tax liability is unaffected even if the business posts a loss. Of course, this is also the case with real property taxes, but there, at least, the benefits test applies. Property ownership imposes costs on local government, and the value of real property is a decent, if imperfect, proxy for reliance on government services, from roads to police to emergency services. Any connection between these services and the value of a company's equipment, however, is far more tenuous. And finally, tangible personal property taxes run afoul of the principles of sound taxation. Various assessment ratios, tax rates, and depreciation schedules inherent in TPP, again, tangible personal property taxation, make it difficult for business owners to estimate their tax burdens and increase compliance costs, undermining tax simplicity. At least part of the cost is opaquely passed along to consumers, undermining tax transparency. And West Virginia, like at least 14 other states, taxes real property differently than tangible personal property violating the principle of tax neutrality. In summation, personal property taxes hinder capital formation, appreciably increase the cost of doing business, and do so in a highly non-neutral manner which discriminates against certain kinds of businesses and certain types of business activities. Ideally, the tax structure should seek to avoid picking winners and losers, particularly if West Virginia wishes to unleash the creative potential of its citizens to drive the economy forward into dynamic new sectors. The West Virginia economy of 2025 cannot be the economy of 2015. And tax policies geared towards the current, or in many cases really the former, industry mix of West Virginia, rather than neutrally open to any industry mix, will hold the state back. West Virginia, of course, has 4 property taxes. Class 1 encompassed all tangible property used exclusively in agriculture and has been exempt for a number of years. Class 2 is residential property and farmland. Class 3 encompasses non-residential real and personal property located outside of municipalities. And Class 4 sweeps up the remaining real and personal property that's located within municipalities. Each is assessed at a different rate, with business personal property taxed typically more than double in terms of effective rates, sometimes even more than triple the residential real property rate. In 2014, on average, residential real property was assessed at a rate of 1.19% of assessed value. And there's an assessment ratio of 60%, so this works out to an effective tax rate of about 0.7% on actual market value. There was some discussion in the previous talk about what that looked like, how market value is determined. I won't go into that. I think that the committee is well aware of that, but about 0.7% of market value. And that's without even factoring in a $20,000 homestead exemption, which reduces state tax collections by about $48 million a year. Incorporate that, and you're looking at about 63 cents on every $100 in market value, easily one of the lowest rates in the country. In fact, the median effective property rate on owner-occupied housing in West Virginia, according to the Census Bureau, is 0.59%, ranking 45th nationwide. Now, census calculations, sometimes states calculations look a little different. So, if you're looking at some of your state numbers, they might be a little different than 0.59, but they're going to be very much in that ballpark, about 60 cents on every $100 in value. And I like to use census because that gives us the comparative figures, every state being handled the same way, and again, 45th according to that measure. In fact, again, that ranks 45th nationwide. Median rate nationwide is 1.04%. Highest effective tax rate is New Jersey's 2.32%, nearly 4 times the rate in West Virginia. Contrast that with, again, that 0.63% mean, or that 0.59% median. Contrast that rate with an effective rate of about 1.31 to 1.72% on business property. More precisely, that's 2.19% for Class 3 property and 2.87% for Class 4 property, but again, assessment ratios of 60%, so you have to account for that in making these calculations. Once you take the various exclusions, exemptions, and abatements into account, the disparity shrinks a little, but even then, collections as a percentage of assessed value are more than 50% higher for personal property than they are for real property, and even higher than that if you only consider traditional business personal property. Previous tax commission in 2006 suggested that on average, business personal property is being assessed at about twice the rate of real property in West Virginia. It's actually relatively difficult to run those numbers, so I have not updated that, but I believe it still roughly holds that it's about double the rate. In other words, even though real property ownership imposes far greater costs on localities, it's business personal property tax that often bears the brunt of the tax burden. Now, it's dangerous to ever speak of consensus on tax issues, but I think it's safe to say that there's a widespread conviction among West Virginia policymakers that the current property tax structure is suboptimal. So what to do? Honestly, one option for localities would be to shift to a greater share of the total property tax burden onto real property, both commercial and residential. Taxes on land and improvements are some of the least distortionary taxes in the governmental toolbox, and West Virginia's real property taxes are among the lowest in the nation. I'm entirely cognizant of the potential political inexpediency of shifting away from personal property taxes, almost exclusively paid by business, towards a greater reliance on real property taxes paid by businesses and individuals alike. Though, of course, you understand that these do end up flowing to individuals regardless through their purchasing patterns. But it does bear saying that on this score, West Virginia is substantially out of balance with the rest of the nation. In 2009, West Virginia had the 5th highest tangible personal property tax collections per capita in the nation, even though its overall tax collections per capita were among the nation's lowest. If so inclined, the state could help guide this process. By statute, each class of property has a maximum rate of taxation. Class 2 property can't exceed $1 per 100 in value. Class 3 is $1.50. Class 4 is $2. A state Supreme Court case, Killen v. Logan County Commission, concluded the uniformity clause required all property to be assessed at full value, so that would be getting rid of the 60%, getting rid of these differentials. They concluded that, but this was quickly remedied by constitutional amendments ratified in 1982. So the state now, of course, has the authority again to create these disparate rates and this assessment ratio. But that authority notwithstanding, the state could equalize the maximum tax rates, or at least lower them, or get rid of some of that disparity to discourage substantially higher rates on tangible personal property, which again, West Virginia relies on much more than the average state. Of course, when faced with an element of the tax code which is enormously distortive, the ideal policy is repeal, with some or all of the foregone revenue replaced by less destructive taxes. I wish I could just come before you and say, it's that easy. Just repeal your personal property taxes, you'll be all right, just go forward with that tomorrow. The reality is that may not be feasible that quickly or at this juncture, and at any rate, full repeal of tangible property tax reform, property taxes, probably isn't West Virginia's greatest bang for its buck when it comes to tax reform. There's no single replacement tax that can cover the losses in all localities, given the wide disparities in collections discussed earlier. An option for localities to piggyback on the tax of their choice comes a little closer. That was discussed in 2006's tax report. but it still falls short and has the potential to create its own problem. And state transfers to offset revenue losses of repeal or abate business tax payments, which was Louisiana's approach to its inventory tax, does nothing to eliminate the compliance costs and could create perverse incentives for localities if they're allowed to continue to set rates, which Louisiana somehow allowed its localities to do, so they could ratchet up the tax no one was paying and then just collect more from state government. Or even if you hold that to whatever its prior level was, at the very least it still rewards localities that already imposed higher tax rates and could well be on property tax bases that change over time. So repeal would be ideal, but if that's not immediately possible, what is? I'd like to propose a few intermediate steps that the state could take to improve its tax structure and make West Virginia more competitive by reducing reliance on this distortionary tax. West Virginia could, for instance, join 40 other states in exempting inventory from the personal property tax base. Taxes on inventory are particularly distortive, falling heavily on certain kinds of operations and often leading to the creation of targeted tax incentives and abatements to retain certain affected businesses, where it would be a whole lot easier, a lot more neutral, to simply begin with a tax base that didn't include inventory. It's the far better option, and again, 40 states have gone this route, and that's a relatively new development. 30 years ago, most states included inventory in their tax base. 10 years ago, a significant number, now down to 10. West Virginia is one of those. That is something that the state could tackle. There, of course, is a cost associated with that, but it is not nearly the cost of eliminating all personal property taxation. The state could also look at partially phasing out reliance on the tax and doing so over time by exempting new property from the tax, as Maine and Kansas have done. This has the advantage of not depriving localities of existing tax bases overnight, while at the same time encouraging economic growth by keeping new and expanding businesses from entering the system moving forward. When they place new property into service, it is not part of the tax base. This has the effect of gradual repeal because as the years pass, old equipment that was taxable is replaced with new equipment that is exempt from the TPP. And of course, you also have the depreciation of that old property. So over time, the tax liability on that old property declines. This gives the state an option, if it wishes to pursue it, to phase out reliance on personal property taxes over a series of years. Of course, you have different depreciation schedules. Some property depreciates in as little as 6 months. A lot is 3 years, 5 years, 7, 10 years. It's different types of property, things ranging from software, which usually depreciates in less than a year, to a lot of manufacturing equipment, which may take as long as 10 years or even longer. So this would give localities time to reduce their reliance over time with some predictability rather than flipping a switch and having all of the existing tax base disappear. It does avoid that steep and sudden reduction, allows it to be absorbed by real property taxes or other taxes over time without large rate increases in other areas. Similarly, West Virginia could adopt a de minimis exclusion, exempting, say, the first 25,000, 50,000, or even 100,000 of business personal property from taxation and not requiring filing if value falls below that threshold. And that part's important because in many cases for these businesses, it's the compliance cost more than the tax cost that is really driving the difficulty for them. This reduces both actual tax costs and compliance costs for small businesses. At least 11 states offer such exclusions. Indiana joined their ranks this year, although with a bit of a twist. They had looked at exempting, adopting a $20,000 de minimis exemption. They concluded that that would be a cost to to all localities in aggregate of about $7 million. And ultimately, because they were seeking other tax reforms, they decided that wasn't an expense they wanted this year. Their solution was to replace it, to impose the de minimis exemption, but to replace it with a $50 flat fee on businesses just tacked onto their business license fees, payable only if they would have taxable business personal property. That $50 fee almost entirely, rounding error difference, covered the cost of the $20,000 de minimis exemption. So businesses are paying the same amount, then what's the point? We've just made it maybe a little less neutral in the sense that everyone's paying $50 rather than paying on their value. The difference is, for most businesses, $50 isn't the problem. The many hours spent calculating your tax liability is the problem. Paying a CPA or having your accountant, having someone figure out what every fixture, every piece of equipment's worth, then applying the depreciation tables and remitting that tax. Very few business owners would tell you that they would rather do that than just write a $50 check. So, I think a de minimis exemption is something relatively easy to do. It could just be an exemption. 10 of these 11 states have just created the exemption and eaten the relatively small tax cost associated with it. Or you can go Indiana's route and say, we don't want to lose the money, so we're going to figure out what the amount may be. It'd be probably a little higher in West Virginia, maybe more like $75 because, again, there's higher reliance on this to begin with. But it'd be a relatively small figure that for the vast majority of small businesses, it would be so much easier just to pay that fee than to worry about the compliance costs. Many states have also exempted specific types of business personal property, like manufacturing and industrial machinery. Again, broad-based solutions are better than narrowly tailored ones, but some states have used this as a way to, over time, phase out the property tax by taking some of the most heavily taxed or most distortive elements of the tax and just chipping away at them one by one. For a well-structured tax, we at the Tax Foundation encourage the broadest possible base so that you can have lower rates. For a tax that probably shouldn't exist, squeezing it out over time and eliminating it through a phase-out schedule can often work. West Virginia could encourage greater tax competition by enacting a local option for personal property tax exemptions. Localities set their own Class 3 and Class 4 property tax rates, but they're unable to distinguish between real and personal property within those classes. If outright repeal of the personal property tax is not feasible, then a local option, either standing alone or coupled with other reforms, could help reduce reliance on the problematic tax while remaining local control of the property tax base. Localities, we heard discussed earlier how localities sometimes underassess to be competitive, but this, of course, is fairly arbitrary. There's not really a system of how you underassess. So a business coming in, unless they have reason to believe that they are going to get that, it's not really predictive. It's not necessarily a reasonable inducement. And of course, it's not neutral because you don't know if you're going to be the beneficiary of that favorable assessment. On the other hand, a locality that is able to stipulate, we do not tax business personal property, is potentially a very competitive place for businesses to locate. And it can put pressure on other localities to do likewise, while recognizing that there are some localities that simply because of their industry mix, that may not be as viable for them. If your entire economy is perhaps a few older manufacturing firms or a couple of coal mines or something like that, which are not very mobile, probably sticking around to the extent that they can continue to operate at all, maybe this is less viable and you make that determination, but let the localities at least compete on this. Of course, there is a longer-term issue that West Virginia faces that's not a tax issue, but it plays into all tax discussions, and that is that as the economy has shifted and continues to shift, there are municipalities that have exceedingly limited tax revenue because they have an extremely small base. You have counties that have very little economic activity. And it is, of course, extremely difficult to continue to provide services with pretty much any tax mix in a locality where the economy just isn't there. And I know that some states in cases like this look for smaller municipalities to potentially unincorporate. Sometimes there's consolidation. These are questions well beyond my ability to speak to. I can speak to taxes, but just recognize the fact that whatever tax mix you have, you end up, whichever one you choose, you're going to have a different distribution across localities and across municipalities, and their survival or non-survival is dependent on somewhat arbitrary choices made long ago. If you had a different tax mix, there would be some municipalities that probably had looked at consolidation already because their tax structure, their just tax base was gone. With this tax mix, you have others that have already disappeared that maybe wouldn't have, and some that are still just barely holding on. And recognize anytime you're looking at local tax reform, you have those onerous counties. You have those counties that their tax structure is heavily, heavily reliant on one tax. And addressing that is extremely difficult. You have sometimes municipalities that wouldn't have existed if you were looking now in a 2015 economy, but they do exist. And they have schools and they have local government services, and these things have to be addressed. Options for local jurisdictions to enact broad exemptions to TPT taxes exist in Alaska, Maryland, Vermont, and Virginia, a list which includes 2 neighboring states. And in those states, localities that choose to exempt the TPP base, even in part, have an advantage over their neighbors with regard to the location of business personal property. It can help incent localities to find superior alternatives to taxes on business personal property. And finally, I'm just forced to note that the tax on tangible personal property is but one of the impediments to growth here in West Virginia. West Virginia has a lot going forward, but there are a number of impediments. The local business and occupation tax, a gross receipts tax, also looms large for reasons not dissimilar to the TPP tax. And while significant reductions have been made to the state's corporate income tax, it does remain 0.5 percentage higher than that of neighboring Virginia. And it's not entirely clear that West Virginia can afford to be bested by Virginia in this regard. West Virginia has made important progress in improving its tax code, cutting an anomalously high corporate income tax rate, phasing out the franchise tax. There's more to do on multiple fronts, but setting the state on a path of reduced reliance on personal property taxation would be an important step forward. I hope some of these suggestions might help move that conversation along. We want to continue to participate in that, and I'd be glad to answer any questions you have.